You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody, welcome back to Options Bootcamp. You guys know the drill. This is the show for you, the basic retail. Maybe you're a stock guy looking to dip your toes in these options waters. Maybe you've already dipped your toes in there. You decided the water's a little cold, a little scary, a little deep. You need a little help navigating those waters. Never fear, we're your lifeguards here to help you out. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network. And whatever you're doing, a lot of you like to subscribe to this program. If you haven't jumped on over and sampled the wares of the full network yet, what are you waiting for? There's a ton of great content there, especially these days. Everyone's got a lot of time on just finding out a stay-at-home order in Chicago is probably going to go into June now. So I got a whole other month of home time ahead of me, and you guys probably do as well. So our content will help you fill that time, a little bit of education, maybe talk you off the ledge a little bit, and hopefully answer a whole bunch of your questions. This is usually the part of the show where I toss and introduce my friend, the black-hatted one, Mr. Dan Passarelli. He unfortunately could not join us today, but he'll be back soon to help us break down all of your Qs and give us some A's out there in the world of options. But never fear, listeners. I am joined once again, holding down the NASDAQ hot seat by our old friend, Mr. Russell Rhodes from EQ Derivatives. Mr. Rhodes, welcome back to Options Bootcamp. I guess we didn't scare you off after the last one, sir.
No, you did not scare me off after the last one, although I'm very intimidated to be sitting in what is normally Jill's seat, because Jill is the bomb.
You could go off and do some trade talks, and then she could swap with you, and everyone will be hunky-dory over there. Are you ready, sir? Are you ready to answer a whole plethora, a whole deluge of listener questions, sir?
I am prepared to do that for about 25 to 30 minutes. Yes.
All right, let's do it then. A little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, welcome to the mail call. Let's get into it. A lot of people will have questions here. Let's see. Let's see how many we could squeeze on. Let's start with Buckeye. A deceptively simple question. People always have these, Russell. You know, they send in the question. Seems pretty straightforward, yet we could easily fill the entirety of the next, 30 minutes with this question. But he wants to know, or perhaps she, what is the one mistake that you see the most often with new options traders. I have a few ideas on this, but you cut your teeth over there in the Options Institute at the SIBO, Mr. Rhodes, where you spend a time educating a lot of new options traders. What were some of the most frequent mistakes you saw with them, sir?
Well, the most frequent mistake that I tried to get people to avoid was buying options for your first option trade, which was a very difficult thing to do because most brokers, they've got all their different tiers of permission levels and those sorts of things. And typically they were only letting you maybe buy a call or buy a put or maybe sell a call against the stock that you owned. And we both know, and the new traders learn the hard way usually, that when you buy an option contract, it typically is overpriced, and you've got to be very, very right with respect to your outlook for the underlying and the timing of that outlook. So my suggestion was to always start out with one of two things. Either maybe a covered call, sell a call against the stock you're willing to part with at a certain price. Then you've got an option on, and you actually do start to pay a bit of attention to it. Or, if your broker will let you, and I've always felt like brokers should be willing to do this, allow people to implement vertical spreads. So they're doing something that offsets that time decay issue that they're going to have to overcome in order to make money off of a long option trade. So really just starting out buying options is the first big mistake, that probably the early mistake that new option traders make. And unfortunately, when they make that mistake, those of us in the option industry might lose them. And that's why I try to point them in a better direction.
Yeah, that's a good one. I tend to lean along something similar myself. And you're right, it is challenging. People get out of that mold of just straight up buying premium, because in the early level 1 accounts that everyone has, that's pretty much all you could do. You could do a few other things, but they really encourage you for that. And it makes sense, they don't want you to blow out, but they're not protecting you against the death by 1,000 cuts that often being long premium can be. And also people will get educated with these expiration graphs showing you, here's the stock at this, by Y level at expiration. If it moves to that level, you will make money on it. There's no real education about, the things like theta that impact that and how you need that move to occur really within a pretty quick amount of time in order for that long premium to avoid eroding to the point where it's all a moot point anyway. So there's a lot of issues that go into that. I would make a corollary to that and say people coming in, and again, it's on the buying premium side, which may surprise people. People might think, it's all about selling puts. No. That's not always the first or indeed the most prevalent mistake we see from new option traders. It's actually coming in. Usually we see the frequent offenders around earnings season. Let's say it's a big name like an Apple or something else, and they're about to have a big announcement, and folks come in and say, I just learned about options. I think Apple's going to go up 20 handles in the earnings event, whatever it is. I'm going to buy these $10 out-of-the-money calls right now. And there's no real due diligence done to what level of vol they're buying, how much vol they're buying, all the other things that are baked into a trade like that. Because you know what happens, Russell, immediately after the earnings event. The stock goes up, maybe as much as they thought, maybe a little less. And inevitably, their option does not perform the way it is because it loses all that time value that was baked in around the event. And as a result, they send an email to us and say, hey, I bought a call. The underlying moved up. How did I lose $8 on this thing that I paid $27 for with 2 days to go? And we always have to walk them through and say, okay, let's do this analysis. But that's the basic homework you need to do ahead of time, listeners. Know the level of vol you're paying. Look and see how that compares to historical levels in your product. That should be the first level of analysis. If you're paying 3x the vol level than what it was typically during that period or during what it was a few weeks ago, you really have to have a really strong reason for that to make sense. And understand that once whatever event is causing that buildup of volatility, I make the analogy all the time to a balloon. Going into the event, could be a conference call, earnings announcement, whatever the case may be. That volatility is building up, and that's like a balloon, filling up with air, filling up with helium. Once the event happens, unless it's an extremely surprising outcome and the underlying shoots in one direction or the other, that balloon's going to pop, and all that vol premium is going to go away. And guess what happens? That option you own is going to erode dramatically, even by the open, the next day. So it could move in your direction, and all that extra juice that you bought without thinking about it is gone, and there's really no way to recoup that. And so that's I would just add that on to Russell's. People think buying options is so safe. And yeah, net premium, you're limited to your risk of that. But in general, it's very challenging to make that trade pay off. That's why I say that's a deceptively simple question. We can spend the whole show on that. Why don't we get some more of you in here? Here's an interesting one. I'm not sure what he's getting at. Daniel P. Kuxero wants to know, what are your thoughts on financially engineering an option strategy to get consistent 8% returns? Go for it if you can do it. Of course, there's a lot of caveats built in there. How are you doing this? How much risk are you taking for that quote-unquote 8%? If you're selling tons of downside premium to guarantee that 8%, and the amount of risk you're taking is not really worth the 8%, then there's a lot that goes into that. But on the surface, Mr. Rhodes, Daniel wants to know, what are your thoughts on, I love his terms, financially engineering an option strategy? This isn't that hard to do. The question is, is the juice worth the squeeze? Mr. Rhodes, what are your thoughts on doing this? I don't know how he even gets 8%, but what are your thoughts on this 8% return option strategy he wants to construct?
Well, the 8% return, you can finance. You know what? I have a degree in financial engineering. I can financially engineer anything that you want based on historical returns and whatnot. I can go find something that may have done this that gives you a consistent 8% return. However, what kind of risk you're taking on to do that? Exactly what kind of environment were we in? Hey, if the risk-free rate was 8% back then people were doing box spreads and getting an 8% return and taking on no risk. So typically when you hear of something being financially engineered, it is being based on back-tested numbers. And I have personal experience from back-tested numbers not necessarily holding true as you go forward, especially if they have been fitted to nail a certain return.
Yeah, like I said, this is not a difficult thing to do to get that consistent 8%. The problem is we're in these environments like we are right now, listeners, where things are not exactly predictable or indeed reliable. And all of a sudden, maybe you took a lot of extra steps to get that 8%. And then all of a sudden, with the underlying moves, WTAG goes negative. Who knows what's going to happen out there? And as a result, that 8% return turns into, a 300% loss because you took a lot of leverage risk to the downside to keep those returns coming in. So again, this is this is an interesting question. And maybe if you send in some specifics, Daniel, on what exactly you're referring to, what underlying, maybe we can help you a little bit further. Okay, the great here wants to know, does anyone offer a pre-earning straddle basket that you can buy to trade a large number of events at once? I am not familiar with this. We talked about this on another show recently as well, similar type of question. I'm not familiar with anything like that. Are you? I mean, the closest I can think of are the folks at RHOADS who put out the data for their earnings straddles, but there's no, at least not as of now, a basket that they create. Granted, if you call up a Goldman or something, they will quote that for you if you have a large enough account. Say, hey, I want to buy all the straddles. They will quote that for you. It'll be an absurd thing to do, but you could do that. If you're Joe Retail doing a 10 lot, probably not. Are you aware of any services or products that I'm missing here, Russell, that will allow you to effectively trade the entire earnings season basket?
Man, that would be cool. If you don't want to trade the full earnings season basket because the full earnings season basket will break even. Trust me, I've tested it. I've looked at what happens around earnings, and if you were to buy a straddle for every, actually what I focus on is the stocks that are in the top 100 of volume each year. I figure those are the most liquid ones that you could do that. If you were to buy a straddle or sell a straddle, or actually sometimes they use a strangle depending on where the underlying was relative to the closing price, if you were to do that and exit it the next day on those 100 stocks, you just about break even minus the spread, minus commissions. So it's not something that you necessarily want to do. The one thing that there's one, there are a handful of broad-based index option markets out there, and the one that really gives you kind of a unique earnings opportunity is the NASDAQ 100, and that's because there are 5 companies that represent like 40% of the weighting. And it turns out this year, or this quarter, in April, in the last week of April, the week ending May 1st, all 5 of those companies happen to report the same week. So if you're really positive on, at least Amazon, Apple, Google, Facebook, and I've forgotten which one I'm leaving off there. But on those 5 big components of the NASDAQ, Microsoft, that's the one I left off. You could actually just buy a straddle in the NDX. Use the May 1st options. And if you think, that they've all been, and I'm doing this without looking at the stock prices, so don't take this as a recommendation. But if you look at those stocks and you're like, they're all beaten down, and I think the news is going to be good for the second half of the year, instead of trading straddles on each one of those, which has higher implied volatility than NDX option volatility going into that week, take a look at the NDX options. The other broad-based indexes are too diversified to do that with, but the NDX is not. And then you can sort of do the same thing with options on some of the industry-focused ETFs. If you think it's going to be a great quarter for consumer staples because we're all staying home and buying toilet paper, maybe you take a look at when do a big portion of those stocks report, and then you translate it over to, what's being priced in by the options on the ETF, because those options will have a little bit lower implied volatility than the implied volatility on the options on the individual names that expire right after earnings. So there's not that service, but there's a way to do that.
Look at you putting the NASDAQ hot seat to work, sir. Well done. Well said.
And this is something that I just wrote up for NASDAQ that got posted on their site recently.
Oh, are you the great then? Did you ask us this question?
I did not plant the question, but I begged you. I sent brainwaves from the Western Burbs to the Western Loop, and you asked the question that was a layup for me. Thank you.
There you go. Ask, and you shall receive. All right, everyone's got some flavor of this next question on their brain. Let's see if we can get a couple of them together, kind of related questions. First off, we got NNJ66 wants to know what happens if the stock is halted or exchanges are shut down when I own puts. Mike Wienick, similar question. If the markets are shut down due to the extraordinary circumstances and I have expiring in-the-money puts that I bought, what happens? Are the expiring options automatically exercised, or do they just expire worthless because the market was shut down? And then another flavor of this question coming from Stock Picker 320 wants to know if the stock market was closed during the expiration date. He wants the other side. And I owned in-the-money call options. I would assume that there would be a mechanism in place, and my broker, TD Ameritrade, would still allow me to execute them before the expiration date on their website or by calling them. At the expiration date, in-the-money options get exercised automatically by TD Ameritrade as long as they're 1 cent in the money. Yeah, that's an OCC thing. That's OCC mandates that. He goes on to write, it could be very dangerous if the call options were only in the money by a few cents because the stock price could gap down when the stock market finally opened, which could result in a big loss if I had a lot of options which controlled many shares of a stock. If my call options were only in the money by a few cents, I would call TD Ameritrade before the expiration date and ask them, do not exercise the options. Unfortunately, this can't be done on their website and must be done by a phone call. I guess that's more of a comment than a question, a very lengthy one. But yes, you are correct. Let's take that last one first because it's kind of the lengthiest one. You are correct there. If they're even a penny in the money, that used to be a nickel a long time ago. Now it's a penny. So if it's even a penny in the money, you're right. Those in-the-money calls will be exercised, and you're right, that could come back to haunt you in a scenario like we saw a few weeks ago where things were crashing and we were hitting circuit breakers and there was a lot of uncertainty out there. You probably don't want to be getting long a bunch of underlying in those scenarios. So yes, that would be a scenario where I would definitely recommend to you to contact your broker. I haven't looked at the specific mechanisms for how to do it. You say it has to be a phone call at TD. I will take your word for that. And however you have to do it, website, email, smoke signal, phone call, contact them and say, yeah, don't exercise these bad boys because I don't want a ton of stock heading my way for a few cents. On the other side of this, the puts side, again, I send all of you over there, OCC Options Clearing Corp. They have a great guide on this exact topic. It's called Unusual Market Closings Guide, I believe. Check it out. It's got all the great, all the scenarios you could possibly think of for these types of things. But one thing I encourage all of you to remember, y'all talking about owning options during this time. Remember, if you own that option, you have that right, but not the obligation, but the right at any time in that option's life to exercise that option. That's something people forget in these scenarios. So even when things are halted, you can call up broker X and say, hey, you know what? I'm going to exercise these puts. So let's say they were out of the money and you thought they were worthless, and then everything got halted, and it's looking like, and the indications are that everything's going to open up when it does, well below that put strike. You probably want to call up that broker and say, hey, you know, those puts that were worthless, I want to exercise those. So you can do that. That's something people always forget about. You can't go in and close them out with a sale or closing transaction like that, but you can exercise them, and that is one of the powers you have in your back pocket if you are indeed a long options holder in these absurd and extreme scenarios. Mr. Rhodes, anything to add here on this question that apparently everyone has these days? What happens to their options if things are halted or shut down, sir?
Well, first off, I tweeted a link to the document from OCC that you just cited, and because they've been getting that question so much, they actually updated it last month. The new date on it's March 2020. The one thing that you do want to keep in mind when you're worried about, being a couple of pennies in the money, the price that they use to determine whether or not that your option is supposed to be automatically exercised is the official closing price at the listing exchange. So, for instance, for Microsoft, it's going to be the official closing price at NASDAQ. And, stocks trade all over the place. So you want to, if you're worried about it, call your broker. Call them up or do whatever, with TD Ameritrade, you got to call them up. But if you're concerned about it, you can tell them, even if it's like, it looks like it's a couple of pennies out of the money, but you just don't want to be surprised, you can call them up and say, if this is supposed to be exercised, I don't want to be exercised, and let them know ahead of time. And again, there's a 7-page document to answer the rest of those questions, and I really do suggest, if it's something that you're concerned about, taking a look at the OCC's relatively new update to that. And like I said, I just tweeted that out, right, in response to us discussing, what happens when we end up with a halt. I feel like there was one other thing I wanted to say along those lines. No, that's good.
I kind of butchered the name. It's actually the unscheduled, not unusual, unscheduled market closings guide. I was pretty close. That's what you want to look for. Just type that into your browser, head on over to OCC, and we'll retweet the link out for you. You should, and a lot of people seem like they have this question, you should read this guide cover to cover. It's not that long. And OCC is the source of record on this. They're the ones who determine all this. So you want to go there and figure all this out for yourself. But that's hopefully helps you a little bit. You have those puts, you can exercise them even if things are shut down out there. A bunch of comments flying in here. Michael Pledger wants to know, what do you think? Let's see if the S&P 500 will break to new highs and continue this time. I hate to break it to you, Michael, but it doesn't seem like that's happening, at least right now. Major indices pretty spooked off this crude oil debacle that is unfolding out here, and so they're off quite a bit the last couple of sessions. Malibu Invest says 2 words, long tankers. We're talking about the big sell-off in crude oil. Yeah, the storage and kind of shipping aspect of crude is doing all right out here right now. Let's see. These are also lengthy. Tell you what, we'll do one more epic one for you guys here. Let's go to Jay Jones. He says, generally trade for credit, either vertical spreads or iron condors. My question for you today is, what is the benefit to trading a pure call or put condor versus an iron condor? The risk-reward profiles at expiration are identical, but it seems like theta decay doesn't help the call condor or put condor as much as it helps the iron condor. Can you give an example or discuss when the call condor or the put condor makes more sense than the iron condor? Thanks so much, and keep up the great work. We touched on something similar to this on a recent show on the network here as well, listeners. This is the question that's come in various flavors recently. But I want to make sure, because it came into this one, that we want to answer it here as well, that this is an interesting one. Iron Condor, of course, listeners, if you're not familiar with what that is, check out the many episodes we've done on this program, including the Spreads with Wings episodes that will help explain things like iron butterflies, iron condors. Very quickly, iron condor, of course, you can look at it as effectively an out-of-the-money put spread and an out-of-the-money call spread, or an out-of-the-money strangle against another out-of-the-money strangle, however you want to look at it. But that's typically what an iron condor setup is. You're going to play with the strikes a little bit to see how far out of the money you get. If you want to go at the money, that's an iron butterfly. That's an at-the-money straddle, and then an out-of-the-money strangle against that. I'm more of an iron fly guy than an iron condor. I've said it before. I'll say it again. I had an old buddy on our Volatility Views program. He used to say an iron condor is an iron butterfly for cowards. That always cracked me up and brought a smile to my face. But Jay here, Russell, wants to know about just looking at the pure call or pure put condor varieties of the iron condor. Are those use cases that you've ever employed? And if so, why? That's probably the best question.
Well, yeah, it depends on what your intent is. Now, the way that I actually trade iron condors is I intend for them to, because I'm going to be right, I expect all the options to expire out of the money. I think that I've got a pretty good idea of where something's going to land, and if I've got a pretty good idea of where it's going to land, and I'm right, and I hold it through expiration, everything's going to expire, and I'll move on to the next trade. Now, if you're putting one of these on with the intent of, maybe trading out of it when we get within a week of expiration. You're just trying to benefit from some time decay. You're okay using an all put or an all call version if it looks like the pricing might favor you. And there are times that, the exact same trade might net you a couple extra pennies or might cost a little bit less, based on which contracts you're picking out, based on what's going on market-wise. The volatility curve is not perfectly flat. So, you might consider, I would never consider, but you might consider all calls or all puts if it's going to save you a little bit in the long run. Now, switching over to butterflies, which is, I'm a wimp, I trade the condors. You're manning up and you're trading the butterflies. It doesn't really matter because you're probably going to have to take something off at some point anyway. So I don't really think it really matters if you're trading all puts or all calls on the butterflies. I think the at expiration difference is the big reason to trade an iron condor with a combination of option types as opposed to all calls or all puts.
Yeah, at the end of the day, there's not a lot of scenarios where doing that effort pays off. And so, as you've seen, sounds like you've discovered that for yourself there, Jay. But a good theoretical question nonetheless out here. If you really want the theta decay, of course, the iron fly. It's going to be all theta all the time. Whether that's good or bad, it's up to you and how you structure it. So, again, to each their own. Unfortunately, that music means we've come to the end of yet another fun episode of Options Bootcamp. I want to thank you guys all for joining us here. I hope you like this new weekly, a little bit shorter, a little bit more bite-sized structure so we can get it out to you every week now as opposed to once or twice a month like it used to be. You guys need a lot of Options Bootcamp in your lives these days. We're trying to get it to you. And again, our buddy Mr. P couldn't join us today. Make sure you check him out, MarketTakerMentoring.com. That's 2 T's, Market Taker. Don't forget the T there. Check him out for his group coaching and everything else that they offer over there. And Mr. Rhodes, if folks want to check out your content, maybe what you're doing for NASDAQ these days, where should they go? What should they do? And also, if you have any hints, it sounds like you got some earnings straddle-related analysis going up. Where should they go to look for it?
Well, I have been putting some of the earnings, potential earnings numbers out on my Twitter feed, which is just my full name, Russell Rhoads. I've started doing things for NASDAQ on their blog site. So if you go under News and Insights, if you do earnings, I think one of my first posts shows up under there. I think I'm supposed to have a homepage, but I got to figure out what the link is to that. But I'm starting to contribute to the NASDAQ blog site. I'll be doing so more and more.
There you go. So just check them out over there at NASDAQ.com. Pretty easy for you to find. And on behalf of Mr. Rhodes and Mr. P and our friends at NASDAQ, and indeed myself, I thank all of you out there for joining us. And we'll see you back here next time for more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available on the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.